Welcome to the Deep Dive, where we deliver the essential insights from the source material you need, fast.
Today we're tackling a real giant, BlackRock. We've got their Q4 and full year 2025 earnings report, which just dropped mid-January.
And our mission here is to really unpack this. We're not just looking at numbers. We're trying to understand the sheer scale of the world's largest asset manager.
Exactly. We need to dissect a record-breaking year, figure out where almost, $700 billion of new client money came from, and how they're shifting from just a huge index shop into a much more diversified financial powerhouse.
Okay, so let's start with the scale, because these numbers are almost hard to believe. Assets under management, AUM, hit an absolutely massive $14 trillion at the end of 2025.
14 trillion. It's a staggering figure. To put that in perspective for you, that's getting close to the size of several major global economies combined.
And that wasn't just market growth, right? This was powered by new money coming in the door.
Oh, absolutely, by flow. They reported record full-year net inflows of $698 billion. That's new capital.
Wow.
In 1 year. That amount of money, that's basically the entire GDP of a country like Switzerland. The velocity of it is just incredible.
And the CEO's quote really says it all. He said the company is, quote, coming off the strongest year and quarter of net inflows in our history.
And when a company that big is still accelerating, still breaking its own records, it tells you something big is happening. Their strategy is clearly working.
So let's unpack that $14 trillion. Because the big number is one thing, but the story is in the details, right? The diversification across products, clients.
That's it. So if we break it down by product, equity is still the giant in the room. It's about 55% of their AUM. That's the core index business for the most part.
Yeah.
Then you've got fixed income, which makes up about 23%. But here's the really interesting part where the strategy is shifting. Alternatives. So private markets, liquid alts. They're only 3% of that huge AUM.
Only 3%. That seems tiny. I feel like that's all management ever talks about. Doesn't that sort of expose them to risk if the low-fee index business slows down at all?
It's a great question. It definitely shows how much they rely on the passive business for scale. But that little 3% slice, that's the future growth engine.
How so?
Because it generates a huge disproportionate amount of their performance fees. We'll get to that later.
Yeah.
The whole game for them is to keep the low-cost equity base humming while you rapidly grow that high-margin 3% into, say, 10% over the next few years. That's the pivot.
Got it. So it's small now, but it's the engine for future profit. Okay, so who's actually investing this money? Is it individuals like you and me or giant funds?
It's mostly the giants. The foundation of BlackRock has always been their institutional clients. We're talking pensions, endowments, central banks. They account for 44% of AUM.
Right.
Right behind them, you've got ETFs, mostly the iShares platform, at 39%. Retail investors, so your everyday investor, they're actually the smallest piece at just 9%.
So they're built on institutional trust and that huge global shift into passive ETFs. What about geographically? Where are these clients?
Overwhelmingly in the Americas.
Yeah.
That's 68%. EMEA, Europe, the Middle East, and Africa is a very substantial 25%.
And Asia.
Asia-Pacific is the smallest at 7%. But, even at 7% on a $14 trillion base, that's still nearly $1 trillion from that region alone. So even their smallest region is huge.
Okay, let's shift from the snapshot of AUM to the actual movement of money. That $698 billion flood of capital, they ended the year with an insane quarter, pulling in $342 billion.
That Q4 number is genuinely shocking. If you look inside it, the long-term flows, so the stickier money in stocks and bonds and alts, that was $268 billion in one quarter.
And the rest?
The other $74 billion went into cash management, which is interesting. It suggests that while clients are trusting BlackRock, they were also maybe a little cautious, looking for liquidity.
So if a chunk went to cash, where was the real acceleration happening? I'm guessing ETFs?
You'd be right. The iShares platform just set another record. It pulled in $181 billion in Q4, and retail was incredibly strong too, adding $82 billion.
$82 billion from retail. That's a lot of confidence. Oh, wait a minute. You said institutions are 44% of their total AUM. Why did they only bring in a net of $5 billion in Q4? That seems tiny compared to $181 billion in ETFs. What's going on there?
That is the perfect question. Because that low number hides two completely different stories.
Okay.
They actually had really healthy active inflows from institutions. About $16 billion came into their active strategies, where clients pay them more to make tactical decisions.
So why the low net number?
Because that was almost perfectly offset by $12 billion in outflows from institutional index products.
Ah, so big clients were pulling some money from the cheap index funds, but putting even more money into BlackRock's higher fee active funds.
Exactly. They are swapping low-fee AUM for high-fee AUMs. From a business perspective, that's a trade you make all day long.
Which brings us to what you call the aha moment, the organic growth metrics. This strips out market moves and just tells you the underlying health rate.
It's the most important metric, I think. It's the organic base fee growth rate. And for
Oh.
the fourth quarter, on an annualized basis, that rate hit 12%.
It's 12% on a $14 trillion company.
Yeah.
That's extraordinary.
It's the number. Think of it like a retailer's same-store sales. It's pure structural growth from clients making a choice to give them new money. And they stressed this growth was broad-based. ETFs, quant strategies, private markets, outsourcing, all of it.
And for the full year.
So a very strong 9%.
Okay, so let's see how that record flow and organic growth actually hit the bottom line. Talk to me about revenue.
Total revenue for Q4 was just over $7 billion. That's a 23% jump from the year before. For the full year, it was $24.2 billion, up 19%.
And most of that is still the stable recurring fees, I assume.
Yep, the workhorse is base fees, investment advisory, admin, securities lending. That was 73% of the revenue in Q4. Very stable, very predictable.
So if base fees are the engine, what were the sort of rocket boosters? Where did the big surprise increases come from?
Two key areas, both right in line with their strategy. First, performance fees. These are the bonuses they get for outperforming. They jumped by 67% year over year.
67%. What drove a jump that big?
Primarily their private market strategies and their liquid alternative funds.
Yeah.
And crucially, this is where we see the first real impact from their acquisition of HPS Investment Partners. That's bringing in very high-margin private credit fees.
So that big bet on alternatives is already paying off on the income statement. What was the second growth driver?
Technology, specifically their proprietary platform, Aladdin. That whole technology services and subscription revenue line grew by 24%.
And acquisitions played a role there too, didn't they? They bought a data company, Preqin.
They did. That growth number includes about $65 million in revenue from Preqin. But even if you strip that out, the underlying organic growth of their tech business, what they call annual contract value or ACV, was still up a very healthy 16%. The demand for Aladdin is real.
Okay, let's talk profitability. This is where it gets a little complex with the accounting, the GAAP versus as-adjusted numbers, because the official GAAP number looked surprisingly low.
Yes, and this distinction is vital. If you look at the as-adjusted operating income, which is the best measure of the core business's health, it was up 22% to $2.848 billion. A very strong 45% operating margin.
But the official GAAP number went down 20%. Why such a huge difference? It seems to tell the opposite story of the flows.
It all comes down to two big non-cash items. First, you have expenses related to those huge acquisitions like GIP and HPS. And second, there's a very unique item, a $109 million charitable contribution in December.
Wait, a charitable gift hit their operating income. How does that work?
Yeah, it's an accounting rule. It wasn't a cash donation. They gifted a portion of their stake in Circle Internet Group, a major digital asset company, to their charitable fund.
Ah.
So even though it's a great use of capital for a good cause, for accounting purposes, it has to be booked as an expense, which lowers that official GAAP income number.
So, if you ignore the accounting noise from massive M&A deals and a 9-figure donation of crypto equity, the actual business performed incredibly well, growing profits by 22%.
Precisely. You have to look at the underlying earnings power, and it was very strong.
And that strong performance feeds right back into their big strategic play, that huge push into alternatives. They are not just an index fund company anymore.
Not at all. They're repositioning the whole firm. They've set this really ambitious goal of raising $400 billion for private markets by 2030. They are signaling to every client that the next wave of returns will come from things like private credit and infrastructure, and they want to be the one-stop shop.
And how far along are they?
Well, their total client assets and alternatives have already hit $676 billion.
Yeah.
That's up from $455 billion just a year ago. The really key number, fee-paying AUM, is up to $529 billion.
And that huge jump is clearly driven by the acquisitions. We heard the names GIP and HPS. What was the direct impact of buying Global Infrastructure Management and HPS Investment Partners?
It was a move to buy immediate scale and expertise. GIP makes them a global leader in infrastructure overnight. HPS does the same for private credit. Just to give you an idea, that HPS deal alone contributed $230 million in fees in Q4. These were transformational deals.
So with all this success, how are they rewarding shareholders?
They returned a total of $5 billion to shareholders in 2025. That included $1.6 billion in share buybacks, which reduces the share count and boosts earnings per share.
And the dividend. That's always a key signal of management's confidence.
It's a very strong signal. They increased the quarterly cash dividend by a solid 10%, up to $5.73 per share. It shows they believe this cash flow is sustainable.
Okay, one last check. You can't have record flows if your funds are actually doing poorly. Did the active funds deliver for clients?
Performance was solid. For the one-year period in their actively managed taxable fixed income funds, 76% of assets were beating their benchmark or peer median.
And in equities. Similar story. In their systematic equity funds, the quant strategies, 78% of assets were above the benchmark or median. Good performance brings in more assets, which creates more fees. It's a virtuous cycle.
So to sum it all up, this deep dive really confirms it. BlackRock isn't just the biggest anymore. They're a massive accelerating flow machine that's dominating low-cost passive while making this aggressive and apparently successful pivot into high-fee alternatives and tech.
That's the perfect summary. They're competing on breadth now, not just scale. And, the CEO laid out a roadmap for the future. He specifically highlighted several huge growth channels they're positioned for.
Right. He gave us a whole list of their next targets.
He did. The list was private markets, wealth and 401k, consolidation, active ETFs, private markets data, digital assets, and tokenization. Now, from this report, we can see they've already executed on private markets and active ETFs.
Which leaves the others.
Exactly. Which leaves you with the question of those remaining opportunities.
Yeah.
The huge consolidation coming in retirement accounts, or the truly transformative potential of digital assets and tokenization. Which of those will be the next big engine that defines not just BlackRock, but the entire asset management industry in 2026 and beyond? That's the question to keep exploring.
A fascinating look at where the next $14 trillion might come from. Thank you for joining us on the Deep Dive.